Good afternoon, everyone, and happy Friday. I'm Evgenia from Runhill Ventures, and I would like to welcome you to our VC Lead Ladies virtual event. As you might know, Runhill Ventures hosts a bi-monthly education series called VC Lead Ladies, which aims to enable a knowledge exchange between female VCs and not only, and inspiring women in tech, an initiative founded by my colleague, Yasmina Darviniza. Just a couple of housekeeping rules. We'll have about an hour of panel discussion and then Q&A session with the audience. Please do not hesitate to share your questions along the way in the Q&A section of the Zoom, and I will make sure we cover them before the end of this webinar. Today, we have an amazing panel of speakers who will share their views on responsible investing and how to integrate ESG factors into the investment process. Thank you so much for joining us today. Could you please briefly introduce yourselves, maybe starting with Lisa?
Good afternoon. I'm Lisa Barclay from Nesta Impact Investments. Nesta is the UK's innovation foundation. We're actually a charitable foundation with a mission to harness innovation for social good. And as part of that foundation, we have an investment team that looks to use some of the foundation's endowment capital to invest in commercial businesses that have a very strong impact thesis integral to the commercial model. So we are investing at seed to Series A stage in tech for good ventures, broadly in edtech, health tech, and increasingly in climate tech.
Camilla, would you like to go next?
Hi, I'm Camilla. I'm a partner at ECA Ventures, and we're a new fund that's focused on consumer technology investing into businesses that are building with profit and purpose. So we have three main areas that we focus on. One is the consumerization of health. The second is sustainable products, services, and supply chains. And then the third is affordable access to basic products and services. And then I just guess the final thing is we're very focused on backing founders, and we've sort of developed a process to sort of analyze what are the attributes that we think make great founders and then help founders post-investment. We invest at pre-A, so sort of seed and early Series A, typically 750 to 1.75 million in the sort of first round of investment.
Hi everyone, thanks for having me here. I'm Hannah, I'm a partner at Houghton Street Ventures. We're raising a fund formally aligned with the London School of Economics, so backing companies that have been founded by students and alumni globally at seed and Series A. I think the reason why I'm here on this panel is that we've been doing a lot of thinking around how we can invest and support companies in being ethical, sustainable, and responsible over the long term. And we've taken a ESG we framed this in terms of ESG. So we've spent a lot of time thinking about how we can integrate ESG across our end-to-end process. And on the back of this have been early stages of building out an ESG initiative for venture.
And hi, everyone. I'm Farhan Lalji. I'm a principal at Anthemis Group, where I am responsible for our venture partnership with BBVA, the global bank based out of Spain. Anthemis is a fintech-focused VC group. We have a number of funds and I think about $500 million of assets under management. And from a ESG perspective, we've always had a mentality around kind of no zero sum, and kind of looking at companies that do good as well as kind of do well from a financial services perspective. And we've been looking at companies, earlier on off our balance sheet investments with companies like Climate Corp, as well as kind of Betterment that kind of try to even a lot of the playing fields. As well from a BBVA perspective, that the bank has placed a real big focus onto sustainability. So we've been paying more attention to that space in recent months and looking to make more investments in that space as well. Thank you.
Great, thank you so much for these introductions. So we know that one of the main challenges of integrating ESG principles is that many still don't really know the difference between the impact and ESG. In simple terms, we usually define ESG principles that are about the internal processes of a fund or portfolio company, while impact investing is about outcomes. So Lisa here on our panel has kindly agreed to do a short overview for all of us of the impact investing and help us understand the difference between impact investing and responsible and sustainable investing.
Thanks, Evgenia. Are you going to put up the slide?
Yes.
Brilliant, thank you. So I wanted to just start by distinguishing between ESG and impact investment, because ESG has become quite a generic term that is kind of used to cover a lot of different approaches to investment and practice in investment. I am active in impact investment, and I think others on the panel know a lot more about ESG than I do. So please do chip in. So I've got a spectrum here of both returns and impact. So we go from traditional philanthropy at one end of the spectrum, which is zero return, but very deliberate impact, to traditional mainstream investing, which is purely for financial return at the other end of the spectrum. And in the middle, you can see we have impact investment, which is around capital preservation, and impact investment where you are looking to make financial returns and deliver a social or environmental benefit, where you may be looking to deliver returns up to market returns. ESG, I think, is quite well described as sustainable, responsible investing, where you are considering other factors beyond shareholders and profit when considering your investment strategy and the investments that you're managing. So I think there is more strategic intent around outcomes for beneficiaries in impact investment, and ESG is more of a framework for making investments and doing business well. I don't know if anyone has anything else to add on that.
No, I think that we totally agree with that. I think we think about ESG as like how you run your business, and it's a framework for thinking about that. And then impact is what your business actually does. And you can sort of have both running in parallel, or you can have them separated.
So moving on to the second slide, there are quite a few parallels, I think, between what we've learnt over the last 10 to 15 years in impact investment and what we're seeing emerging in ESG. And one of the observations is that, you know, these are concepts that are relevant across the life cycle, across the investment life cycle. So from your kind of strategic intent through to exit. This on the slide is a framework that the International Finance Corporation published a couple of years ago. It's pretty generic. It was intended to kind of summarize the approach to impact investing, but I think is equally relevant to thinking about ESG. So from the outset, thinking about your investment strategy and how impact or ESG fits with that strategy. When you're looking for investments and making investments, you might have a list of exclusions, things you don't want to invest in, but also looking for those key factors that will deliver you your impact, or the key ESG factors that you know you want covered. Similarly, in portfolio management, as an impact investor, we will identify certain KPIs, impact KPIs that we will want to monitor and measure throughout the life of the investment. We may want to change those if we're learning different things from what we're seeing on the ground in that investment. And I think equally with ESG, you want to monitor progress and identify areas that need action through the life of the investment. And at exit, you know, exit is quite a tricky question about how do you bake in impact to exit. And I think that question is getting easier as there is more acceptance of ESG factors across the market. But it remains a question of how does an impact investor guarantee impact preservation at exit? equally, I think it is becoming a question as to how ESG factors can be sustained at exit. Just going on to the next slide. Again, some parallels to draw from the experience of impact investing, in that there have been a kind of myriad of impact measurement frameworks and approaches, and everyone is kind of looking for the holy grail of a single scheme or framework that everyone will use, so that there can be industry-wide benchmarking, portfolio measurement and benchmarking around impact. And I think equally with ESG, we're looking for what that common framework might be. In the impact arena, the Impact Management Project has done a really good job of bringing together hundreds of investors across the world and working out a common framework, some principles that are not too prescriptive, but give a kind of suitable framework for individual fund managers to develop their own way of thinking around impact, and also measurement and management of that impact. And I think that kind of gives hope for ESG that similar might happen over time, in that there might be a kind of coalescence towards a common framework.
Well, that's very interesting and helpful, Lisa. Does anyone want to add anything from the panel? Great. Well, I guess it was a very helpful introduction for all of us to better understand the differences between this concept. But we know that according to industry research, more than 70% of institutional investors already integrated ESG practices into their selection and management of their investments. And now they span across major asset classes, from public companies, private equity, real estate, bonds, commodities. Yet venture capital has still lagged behind other asset classes, with no real systematic approach to screening, managing, or reporting ESG performance. So what is your view on that? How the industry has changed recently? For example, Farhan, have you seen any changes towards a more ESG-focused approach?
Yeah, I mean, I think it's definitely, people are paying a lot more attention to it. And I think kind of going back, I think the other asset classes, have been kind of pushed by their investors, right, to kind of pick that up. And I think we're now starting to see LPs also pushing venture investors to kind of have that focus and report or respond to questions around that. Because really, I think that's going to be the driving force. I think that the question is, though, from a venture perspective, how do we make these metrics, the measurements, scalable and sustainable, right? So that it doesn't feel like a trend and an uptick, but that we really provide solutions that are lasting in this. And I think that's why kind of ventures lagged a little bit, because I don't think we just want to put kind of lipstick on the pig. I think we want to kind of say, okay, how do we actually make sustainable, scalable solutions to be inclusive, but also to be correct in terms of how we measure, how we report, how we decide what is a good investment from an ESG or an impact perspective as well.
Right. So thank you for that. So even though there have been positive changes in the industry, it seems like we're still quite a long way from reaching maturity on the subject. And Camilla, as a founding partner at EK Ventures, how was your experience of raising a fund with a sustainability investment strategy, and what was the market reaction like?
So I think it's been a really interesting experience. So we sort of kicked it off a couple of years ago. And I think at that time, it was when we'd seen that sort of massive shift in the public market. There'd been a shift at late stage in the late stage venture plate, so the late stage private equity space, with sort of funds like KKR and Bain Cap raising big ESG funds, but it hadn't really yet sort of hit the venture market. I think what we've seen is like a massive shift over the last 18 months towards LPs really like waking up to this trend and the sort of commercial benefit that this trend can have. So it's been really exciting to see that. I think the UK is also very fortunate to have sort of LPs like the big society capital, who are incredibly progressive, and they're working with sort of emerging managers like EK to try and think through what is the best way of applying sort of ESG and the best way of applying sort of impact into an early stage context. And sort of by having LPs like that can sort of help move the industry and create those frameworks, I think that's helping to get other LPs more comfortable around what this sort of looks like and how it can be applied, and the fact that it really helps companies sort of build competitive moats rather than sort of ends up with those companies sort of effectively in the sort of the non-commercial bucket. So that's been exciting, and it's been exciting to see the speed of change happen both within the industry and within the LP base.
Can I just add something? I think it's super interesting because we often hear that, the pressure's coming from LPs. I think it is coming from some LPs, the ones who are slightly more progressive. And if you look at Europe, there are a bunch of LPs in Europe that are very forward thinking when it comes to ESG specifically. But interestingly, I don't think that applies to lots of LPs. I think lots of LPs have the intention to change, but they don't really know how and how they can get there. I would also add a couple of other pressures that are kind of driving more kind of ESG activity within venture. And I think that's, you've had massive public fallouts in big tech. So you've demonstrated what happens if you don't solve a lot of these problems earlier on. If they're not established early and they let loose, what can happen? And then you've also got in big tech increasingly employees, gaining a voice and taking action and holding their bosses accountable, which is causing quite an uproar. When you look at the work Midya are doing on their ethical explorer front, they're tackling that specifically. And then I think lastly, you've got COVID. And I think that's why, at least we've understood over the last 8 months, 8 to 10 months, the conversation around ESG within venture have just kind of snowballed. And I think COVID has highlighted so many weaknesses in certain areas of a business's general structure, specifically around how they treat their teams when they're working remotely, like supply chain weaknesses. So I think that the confluence of all of those things have accelerated a lot of those conversations, and not necessarily just with impact-minded investors.
Yeah,
I agree.
Sure.
So I was just going to agree absolutely with those points, and particularly what Hannah was saying. I think COVID, along with Black Lives Matter over the last year, has just brought these kind of issues and risks to the forefront. I think also there's another angle around, we talk about LPs, the supply of capital, but I think also the demand for capital from entrepreneurs and founders who are now Gen Y and Gen Z, and really more demanding on this front, looking for capital that matches their values.
Yeah, you're raising very interesting points there. And so you mentioned the pressure from LPs. Do you think they will be a changing force, a driving force for industry approach and being more ESG centric? Hannah, maybe you have some insight on that.
Yeah, I mean, I absolutely 100% think LPs will be, if they kind of demand or integrate ESG or impact so strongly into their screening and due diligence process, then that will drive a lot of change, of course. I think, someone said to us last week that there's a reticence to do that in case they ask for too much reporting from their GPs, and they will lose out on deals. I'm not sure which ones they're talking about there, but there is that concern. But I definitely think this is it's going to be driven a lot by LP pressure.
Yeah, and I think you mentioned also that in Europe, Camilla and yourself as well, that there is more interest from LPs' perspective to invest in more ESG-focused funds.
Yeah, I think that's definitely true. And I guess when we think about sort of what we're trying to achieve with the fund, it's proving that commercial impact generates outsized returns. And I guess, in the same way that venture funds are trying to sort of create positive impact and really great returns, that's the same as what LPs are doing. So I think as we start to see more companies that are generating outsized returns while sort of showing that those sort of strong sort of impact and ESG angles, that's going to get more LPs excited about what that opportunity looks like. So it's a little bit of a sort of circular system from that degree, but we are starting to see some amazing companies that have a really strong, clear sort of mission alignment that are growing. at an incredible rate and are like proving that you can make these incredible returns out of businesses that are run responsibly. And I think that really helps to like change the perception across the whole industry of like the benefit of investing in this way in asset class.
Yeah, and I would totally echo that and say, just add one more thing, that I think traditionally ESG has very much been perceived as a risk that you need to manage. It hasn't really been seen as a strategic value driver. But I think it's changing, and people are seeing that it can actually drive the long-term commercial value of a company.
Yeah, that's really ties nicely to what Lisa was presenting to us, the move from just avoiding harm to actually benefiting and contributing to the positive outcomes. So I would like now to actually ask a question to our audience, because we have a lot of people from the VC and tech ecosystem today, and to see if they have already implemented any formal ESG practices in their day-to-day work. So you can see now the poll on your screen as a pop-up, and the panelists, you can also vote too, of course. And if you're using a mobile version of Zoom, you will see on top of your screen a phrase saying poll in progress that you need to click on to access the poll. And after you choose the appropriate answer, you can click submit. And the question is, have you formally integrated ESG principles in your company's policies and activities? Yes, no, or you're in progress of doing that. So I see many of you already voted, and I'll just give you a couple of seconds to finish submitting the poll. So we have almost 80% of you who voted. So I think I'll end the poll now and share the results with all of you. So as you can see, we have the majority of answers for the answer number 3, in progress, which is probably not surprising and hopefully optimistic and promising for all of us. And Farhan, would you like to maybe comment on these answers?
Well, I mean, I think to be honest, the 38% feels higher than I would have thought, right, as well, because I think it is quite early, and I wonder if there's some self-selection happening around who's kind of interested in this kind of subject coming in, and we're seeing that a lot of people are working on it overall, which is great to hear. The curious thing I'll have to say is, like, when we get some standardization, when we get some sharing of best practice, I'm really keen that, like, groups like ECA and Houghton, and you guys are doing some great work alongside Nesta. How do we get more of that to become industry standard? How do we share some of that, whether it's like the open source model or talking more about it to some of the people who maybe aren't in the room, who haven't kind of picked this up? How do we drive kind of that forward? I think that's going to be when the industry shifts, so it becomes not, are you doing this? It's like, kind of, how are you doing this? I think that's going to be the interesting tipping point for us to see it becoming more standardized.
Yes, I think you're raising a very important question on, we still lack any industry standard for ESG reporting in VC. And for example, Lisa, in your opinion, who do you think would be responsible for figuring this out? Would it be any industry organizations such as BVCA or Invest Europe, or should it be the government or individual VCs? Who do you think should take the lead on that?
Well, as I was saying earlier, I think the impact management project set quite a good precedent by bringing together practitioners in the industry and combining experience and thinking to come up with a framework that is usable and applicable across the industry. And it would be fantastic if that could happen for ESG at the venture end of the spectrum, I think, as well. There are a couple of initiatives out there. I know Hannah's leading one, which is really exciting and helpful. There's B Corp, which has quite an involved assessment across many different aspects of customers, supply chain, governance, environment, community, and whether you're a company or an investment manager, you can go through that assessment and get a B Corp certification, which then you recertify every 2 years. And it's going beyond ESG. It's kind of somewhere between impact and ESG. I think it's quite a big commitment, but it also is becoming, I think, a kind of good kite mark for managers and companies that want to show that they are doing business responsibly. So there's that. The BVCA has a responsible investment toolkit, which is quite helpful, quite high level. I came across through Hannah's initiative 500 Startups, which is a US venture manager, and they've got an ESG policy, which I think looks really quite easy, intuitive, and sensible as a starting point. So I think there are quite a few initiatives out there which could be relevant to the venture end of the industry. But I think, as Farhan was saying, getting to a common view on that, I think would be helpful.
I think one of the issues is, I mean, if you're talking about LPs, they want something that's kind of been endorsed by the UNPRI. Like they want the UNPRI to come up with a framework that they can use. The UNPRI currently doesn't have a framework for VCs. They're working on one around late stage venture, but that won't look at kind of pre-seed, seed, and Series A or Series B. But I think one of the issues is that everyone's kind of alluded to is that there's no referenceable framework or guideline out there. So even if funds do want to do something, they don't quite know where to start. And then there's also the issue of we're all very time strapped as fund managers, and companies are time strapped at such an early stage if they're small. So it comes down to the point of like, what is material from a risk and a value perspective for these companies, and that kind of materiality exercise hasn't really been done at the early stage company level. So I think there's maybe a community effort which we hope to play a small part in, that can actually put lots of our kind of minds together of people working across stages, across sectors, across regions, and actually come up with a guide. Maybe it's a bit of a lofty ambition, but why not have big dreams?
Yeah, and Hannah, your initiative of bringing together different VCs and talking about ESG has gained a lot of interest recently. I think it's more than 50 VCs that have joined the initiative, right?
Yeah, I mean, joined. We're not, really early. We haven't really done a lot. So, but I think that just shows that there's a lot of interest in this. So that's kind of exciting. So if we can, we've created a few working groups. If we can start moving forward on some of this stuff, we're working with the BVCA. So, if we can help kind of inform something as a collective, then that would be wonderful. And I think something I've said before is it's really nice that this is something we can all kind of collaborate on and share on. VC sometimes has like the walls up, but I think on this front we can all kind of do stuff together.
Yeah, that's really helpful. And Camilla, I know that EK Ventures is on the investment committee of BVCA. So do you see any initiatives or plans to also define a more precise ESG framework for VCs, especially early stage?
Yeah, I think it's a really great idea, and it feels like the BVCA has a fantastic standard set of documents, which I think are at the base of a lot of very early stage investments, and so incorporating some type of principles within that would be a really effective way of sort of scaling a more standardized approach to ESG. I think one of the frameworks that we find really valuable is the Big Society Capital has something called the Responsible Business Practices. And they're sort of based around 4 guiding principles. So business integrity, fair dealing, good citizenship, and respect. And then there's like sort of details underneath that. And I think having those types of principles that are like clearly applicable to all businesses are sort of like relatively easy to adopt into documents. It could be a really effective way of making this become more mainstream. I think we're very cautious that the sort of the stage that we're investing into, as both Hannah and sort of Lisa have alluded to, it's really important that it's appropriate to size, and that there isn't sort of, additional administration that has the potential to sort of to stop companies reaching their full potential, whereas something like this, which is very positively focused, very focused on like helping to make the right steps, and you can easily take from the legal documentation into companies' own policy booklets feels like the way that you'll sort of drive that change, both from a documentation sort of management perspective down into the company level in a really effective way. And we started to see that happen. So it's something we incorporate in the documents of our portfolio companies. And I think the most exciting thing is a lot of the founders have like taken those principles and then they've incorporated them within sort of the principles they use on a daily basis with their teams. And that's, I think, how you really drive this like thinking around responsibility, rather than it being a sort of tick box exercise at the end of the year when you're like, oh, got to check that I've done all of these things, and then sort of backtrack into the things you might not have done to make sure you get a great score. So we're very in favor of trying to help be part of creating a sort of industry principle-based approach to it.
Yeah, I think it really raises a question of why VCs adopting the more ESG-focused approach, what is driving them, and what would drive the responsible, sustainable investing in future. So maybe I would like to ask another question to our audience and get their feel on that. Let me just share another poll, and obviously panelists, you can also vote too. So just to really get a feel for what you think is driving the growth of ESG-focused investing. So the question is, VCs integrate ESG into their investment decisions in order to mitigate risks, respond to LPs' expectations, generate higher financial returns, or act responsibly. Of course, I understand that probably many of you would like to choose all of the answers, all of the above, but it would be interesting to see the preference of the audience. Okay, we have more than 60% of you voted. I'll give you just a couple of seconds to make up your minds and click submit. Okay, I'm gonna end this poll now and share the results with all of you. Great, so we see that LP's pressure will be probably one of the strongest driving forces towards the ESG-centric approach. Would anyone from the panel like to comment on this result?
I'll bite. I mean, it's interesting because like I had made the point earlier about LP's expectations, but didn't personally vote for that. My personal take was acting responsibility, and I think you're right. It's probably a combination of all of those kind of things, and that's probably why we're seeing a spread in terms of the results, right? But and I don't think that's necessarily a bad thing, right? Having like multiple factors driving this change, as long as the change happens, right? And if the knock-on effects are that LPs get more of the insight into this because venture investors are acting responsibly, and we hopefully get higher outcomes. And whether that's because of the quality of the companies we invest in, whether that's because we're minimizing downside risk on some of this, I think these are all kind of working in coordination, is my view.
Yeah, I think it would be probably also best to add one more point. I think as Camilla previously pointed out, that the push from the founder's perspective also would be a strong one, because if we want to act responsibly and solve societal challenges, we also need to lead by the example, right? And I guess our audience would also like to hear more practical examples of how you integrate ESG goals and considerations in the different areas of the fund's life. So for example, if we talk about internal operations of the fund, Camilla, what are your kind of ESG standards and specific metrics maybe you track or recommend tracking?
So I guess we're sort of relatively early stage in the sort of fund. So we have an ESG policy, which is sort of, I guess a more traditional policy. And then we also abide by the sort of 4 responsible business principles. And I think we apply those business principles as we make decisions within the business. So I guess I'll give you 2 sort of concrete examples of that. So One of those was, as we were sort of raising the fund, we considered bringing on board an intern or an analyst, but we realized that we couldn't pay sort of market rate for that individual because we were sort of in the process of raising the fund and it didn't have sufficient budget. We decided not to do that because it would have meant that we only could hire from a pool of candidates that were able to afford not to take a market rate salary or not be paid at all. And we didn't think that that sort of fitted with the idea of sort of fair dealing and like giving everyone equal opportunity. And so we sort of made a conscious decision not to do that. I guess a sort of second example is, as we've sort of been through the fundraising, we've been very mindful to have LPs that are aligned with the mission and vision of the fund, and to make sure that those LPs like have a sort of either have the same sort of principles or a sort of desire to sort of move in that direction. And that has meant that we said no to a number of LPs because we didn't think that they sort of reflected the values that I guess we're trying to sort of represent as a fund, and then also really important to the companies that we're speaking to. And we do get asked a lot by the companies we're investing into around like how we're sort of implementing this ourselves as a fund, who we're supported by as a fund. And I think that we're starting to see that's a competitive advantage in winning deals, which I guess has a virtuous circle of making sure that we sort of focus on it even more over time as we grow.
Great, thank you for that, very interesting. And Hannah, in your research and group works on the ESG and VC, I know there has been a lot of also discussion about the internal operations and kind of what processes VCs need to implement in order to adopt ESG policies, and also what metrics can we use to measure the progress of these processes?
Oh God, that's a massive question. So full caveat, we're not deploying capital yet. So we really hope to live the values that we're trying to kind of instill in others. But from our perspective, the way we've mapped it is, it comes into screening. So how you're, what you're screening your companies on, like what you're asking them at due diligence. And I think when they're such early stage companies, it's very hard to, there aren't a number of things that you can ask, but things like what does has the founder thought through their adverse impacts of their business? Have they thought through what ESG means? Like, have they thought through what they want their business to be in 10 years and the role it wants to play in the world? And then are there any big ESG red flags relating to ESG in their commercial model or business model? So anything, for example, around the makeup of their supply chain. And then we go through that we have a classic exclusions list. And then once you've invested, we take them through this. It's not a checklist, it's more of a kind of a discussion document where we help them. It's across 8 different areas. I won't go into it, but it's basically trying to gauge what their priority areas are, where their blind spots are and what their gaps are. And then we work with them to set targets and goals, which we then review on a periodic basis. So in terms of the company side, that's what we've laid out. And then metrics, oh my gosh, that's a really, really hard question. So we have this structure of the 8 different issue areas, and we've started by kind of coming up with about 10 to 15 metrics that cut across all of them. And the hope is that these are metrics that are standard across all types of companies, regardless of their stage and sector and region. But we're increasingly realizing that might not be entirely feasible. And this is sorry if you can hear that noise. I'm in a really loud Hackney. And I think, but this is one of the questions that we're posing with the big group, and that we want to work through. So what is feasible from a metrics perspective? What can companies actually ask? What can funds actually ask of their companies, and what frequency? So what is it's kind of trying to be ambitious yet realistic, and walking that line. So that's a really bad answer because I kind of evaded it. But I think it's a work in progress.
I think that's where the IMP framework is so helpful, because it is like really easily applicable to every company, and it actually helps that company really focus on like where their potential competitive advantage comes from. And so I think every time we've sort of run it with a founder to date, it felt like it's actually just honed in on like what your difference is as a company, and then the metrics that help support that. So for example, we're an investor in an insurance company, and they track the percentage of individuals that didn't have insurance before signing up. They're sort of in the process of launching a social housing product, and that sort of came off the back of like tracking certain segments, and then finding that those segments actually had like a really good NPS and sort of really good promotion around their sort of product. And so I think that IMP framework is really very strategic and helps you work through sort of what the commercial advantage is, all the way through to sort of impact metrics and ESG metrics that you can sort of track at it relatively easily because they sort of fit with what the business does on a day-to-day basis.
I think for an impact perspective, that's really valuable. I think the way we're looking at it is more things like, responsible product design. So have they got a responsible product statement or an ethical responsible statement? Have they everything across data privacy and security? Do they have a data management policy? Is there someone responsible for data within their team? Team and working environment. Like, what about paternity, maternity policies? What about their options? Like, are they tracking turnover? Are they doing exit interviews? So more kind of the stuff that is
business operations.
Yeah, within the four walls, but that's just really kind of operational best practice. So the stuff that doesn't necessarily directly affect the impact that their product or service is having on the community.
Yes, that's very helpful. And Farhan, you also have extensive experience both on kind of operational side of things and on the C side. How do you approach the kind of the portfolio management and the questions that Hannah and Camilla just raised about ESG policies of the companies you invest in?
Yeah, so kind of in a previous life, having been an entrepreneur and having had my fair share of failures and a modicum of success, I kind of try to empathize with the founders, right? Because we're asking kind of quite a lot from them, right? And kind of going back to kind of my time as a founder, you have like 1,000 plates kind of spinning at the same time, right? So a lot of times it's about kind of signposting and supporting, right? And trying to kind of guide them, right? So kind of saying, okay, like, how can we help you think about the right data privacy policies? How can we help you thinking about, kind of things like maternity leave, right? And, as when I was a 30-year-old founder, right? I mean, I was in the process of becoming a dad, but I hadn't even thought about a maternity policy at that point, right? And I think it gets overlooked, and not by ill will, right? But I think it's up to us as investors to kind of coach and mentor our founding teams kind of through some of that process and help kind of identify how it's going to impact their business in a positive way as well. And I think like from a fund perspective now, and as an investment manager perspective, there's probably different stages that different funds are in, right? And as a minimum, we're signatories on the UN PRI, I think it's called, right? And so like you've got some kind of way that you can also signpost, that you can hold yourself accountable, right, as a fund, even if you're not, at the core saying that you're going to invest in ESG or you're going to invest in impact, right? You can kind of look at some of these frameworks and principles and start implementing that, and slowly, hopefully, create more change in your organization as well. And then hopefully that bleeds into the founders and the companies you back as well. Yeah,
you're raising a very important point there, but how do you actually influence the companies being minority shareholder? Does it, do you feel like you're able to actually influence and impact their policies? And
yeah, definitely. I mean, I think like you can always show the return on that investment, right? And why that's going to be a positive win for them to implement some of these changes, right? And at the same time, like, as a board member, they tend to listen, right? They kind of think that you're an oracle sometimes, right? Even though you're not, right? In a lot of cases that there's some kind of like, whether it's an introduction, whether it's a business development opportunity. I know like when my previous investors gave me some guidance or gave me some feedback, regardless of whether they were a minority shareholder or whether they were a board member, you tend to kind of take those things seriously. So I think like we have a responsibility then to hopefully kind of influence our founders and our founding teams and our companies to kind of take some of these steps as well. I don't think it's acceptable to say that, kind of, I don't know if they'll listen, so I won't. I mean, we send a lot of surveys out kind of asking for data, and sometimes we have to ask multiple times. But it's quite interesting that, we still gather the data. And I think that's kind of an important step towards kind of continuing the process.
Yeah, no, that's really interesting. And what about this ESG criteria? Would it be kind of a deal breaker if you looking at a potential investment? For example, you know, diversity and inclusion, obviously a big topic, and that's why we're all here today. And it gained a lot of even more traction last year. So would it be, for example, a deal breaker if you see the amazing founding team, but it's not very diverse?
Well, I mean, we'd have a conversation, right, around the policies or around kind of where you're going to go as a company. We're really fortunate in that, you know, we've invested a lot in our portfolio success function. And that team spends a lot of time kind of thinking about this. So working with the founders. And to be honest, that response from a founder around this particular area is also going to be indicative of how other kind of interactions with the founding teams are likely to go, right? So you can always kind of use this as a signpost, or use this as kind of like almost an experiment, right? In terms of, if I can guide these founding teams and these prospective investments towards kind of changing the way they think about, you know, some of these fundamental principles, will it then become easier to also kind of coach, mentor, and support the founders later on? Because I mean, it is a relationship between an investor and a founder. And I think you have to start off, you know, kind of with some of these big important things, so that when it becomes incremental, small kind of matters of coaching, whatever, there's a level of trust there on both sides of that table.
Yes, that totally makes sense. And hopefully we can all adopt this approach as investors. And Lisa, maybe from your perspective, how do you support your portfolio companies in adopting more ESG-focused approach?
So through the due diligence that we do, we are building up a sense of both the kind of impact intent of founders, but also their kind of perspectives around ESG issues. And this might be controversial and not for everyone, but we do ask for some things to be baked into the legal documentation. So, for example, on the impact side, we look for a social purpose clause to be inserted in the articles. And typically that's just not an issue in terms of the kind of founders that we're talking to. We've also looked for certain policies to be required, and, you know, certain kind of best practices around governance, like setting up audit committee, remuneration committee, etc., having regular board meetings, board reporting. So all of that is actually baked into the legal documentation. And you never want to have to look at the legal documentation, but you've been through a process and a discussion about expectations, and that kind of sets the scene for the relationship and kind of practice thereafter.
Yeah, that's really interesting. And we talked quite a bit about the portfolio management and companies we invest in. But if we go back to the internal operations of the fund, which we all agreed was also very important to show that we are committed to ESG as well. Camilla, maybe since you have an experience of raising a fund with a sustainability focus, and you mentioned that you have certain commitments that you require portfolio companies to adhere to. Do you also have you also implemented some formal ESG processes for the internal operations of the fund, of your team, of the internal processes and operations?
Yeah, we definitely have. I think we, as I sort of mentioned, we're very focused on this idea of like responsible business practices, and those being like the sort of guiding way that we operate. And then we also do report to our LPs around, I guess, more related to the impact side of things. So we sort of report to them on like how we're performing in terms of the level of impact that us and the portfolio companies are having.
Mm-hmm. And Hannah, do you see any kind of big changes happening in terms of how LPs, do they also join your initiative, or is it mostly focused on VC side of things? Sorry, you're on mute.
Yeah, we've been engaging with the LP community briefly. I mean, through our conversations, we've realized that there was a desire on their part to learn more about how to go about screening and measuring and reporting on ESG at the venture stage. It seems that a lot of the a lot of the LPs, kind of endowments and funds of funds and family offices and pension funds all have the same screening process across all asset classes, but they are more interested now in kind of diving deeper into venture. So we held a session to bring them together and to, you know, share insights and swap notes. And I think, you know, hopefully we'll maintain that and keep in touch and see how we can turn that into a regular series. Because I think actually having LP insight for GPs and also conversely GP insight for LPs is really useful, especially around this.
Yeah, thank you for that. And maybe a question to everyone. So obviously ESG is a very broad topic, and there are many factors and societal challenges we can focus on. Can be environmental, social, diversity, governance, data privacy, so many different things. So how do we choose which one to focus on, or should it be all equal, or do you set any different weightings for different issues depending on the focus of your fund or things you're looking at more deeply at from the investment perspective? Or yeah, would be great to hear your thoughts on that.
I feel like I'm a bit biased because I from what we've seen, lots of funds seem to be focusing on delving deep into some areas and tackling it kind of incrementally. So, you know, D&I obviously with the work that Diversity VC has been doing, and others, like that's had a lot of focus. And so people are kind of really making tracks there, and then maybe on the environmental side by mapping carbon footprint and putting in place. But I mean, I feel like that's, I mean, everything is great. Like any change is positive, but I think there are probably little things that we can do across all the different areas. But I do also think, going back to what I said before, that whole process of doing the materiality assessment, kind of alluding to Camilla's point about the IMP, but maybe taking that process and applying it to ESG could also be done, which will help really for a fund and a company prioritize what needs to be done at that point in time. And then as they grow, you can then feed in the things that are then relevant, more relevant.
And Camilla, maybe from your perspective, how do you choose on which topics you want to concentrate, which societal challenges to solve?
Yeah, definitely. So I think I guess we start from the sort of point that we're looking for businesses that are being impactful, and then we take quite a wide definition of that, and then we put them through the sort of IMP framework to make sure that we're really confident that they're delivering on the sort of impact that they've sort of laid out to do, and that we can like very, very clearly track that. We made a decision not to go down into like very specific sort of challenges, because we felt that can actually distort your decision making, and it can mean that you end up taking non-objective decisions in order to sort of meet targets that aren't necessarily sort of the appropriate target for sort of what we're doing. I think what we have found, which is really exciting, is that by having the IMP sort of lens, by being very clear on what our investment focus is, and then running a leadership assessment, which is a sort of structured way of assessing founders, we've ended up with very good diversity, for example. So we have very good diversity through the sort of the deal flow pipeline into the companies that are coming through to IC, and then the sort of 3 investments we've made as well. We've got sort of 2 female founders in those, and like good ethnicity diversity as well. So we're finding that by having a structured process and by having a very sort of clear thesis around backing companies that are looking to build with profit and purpose, that's meaning that some of those like big topics we're sort of seeing come through in the data, but we don't make decisions around specific sort of topics that come up as sort of key issues. We're trying to sort of like look at solving the really big problems and then track the data underneath that to check that means that some of those other things are also being solved at the same time, which at the moment the sort of data suggests that they are being. So we're sort of good with that. I think the really key thing is to be able to like actually track that data, so that if it looks like some of those topics aren't being addressed, then you're able to try and understand why, rather than sort of set out in the other direction, basically. So that's how we work through that at the moment.
Yeah, so I think in one of your interviews you mentioned, Camilla, I think was really interesting, that actually we don't need to separate ESG and impact, and then actually the best outcome is when we can have impactful technologies done with a kind of responsible ESG approach.
Yeah, I think that's exactly what we feel. We're like, you know, if you've got founders that are trying to solve big problems with like high social conscious, then they're going to end up like running their business in a great way, in a responsible way, and the outcome for everybody, including their employees and their shareholders, and ends up being sort of strong and positive. And so that's why we're so focused on this idea of like responsible business practices and then sort of metrics that we can measure to make sure that there is a sort of alignment with like what the founders are sort of talking about and what the business impact actually is.
Right, thank you for that. And Farhan, I know you focus more on financial services, but it's also still a very large topic. So how do you kind of choose a granular ideas and topics to focus on within this industry?
Yeah, I mean, I think that the thing to realize about Anthemis that we're quite in a fortunate position that we have a number of different vehicles and funds that focus on very different kind of areas, right? And so when we collaborate and when we kind of share ideas, you kind of influence each other, right? So you have a team that's focusing on financial wellness. You have a team that's building a female innovators lab in the US. You have a team, as in my case, which is focusing right now, at least on sustainability from an environmental perspective, right? So when we start presenting these deals to the rest of the group, right, it starts to hopefully kind of bleed into these are things that are important. These are areas that can be competitively advantageous as well. And for other investors who don't necessarily have that same kind of DNA in the organization or even scale, I would kind of really recommend really taking a hard look at who you co-invest with as well, right? And what they bring to the table in terms of that understanding of a specific area, a specific sector, a specific focus, and how they can influence your own thinking and your evolving as an investor around kind of understanding why these things are important and how you can make a difference into that thinking as well. So I think like those are ways in which we look at it. It's like, I'm not going to know everything about societal norms or governance or the environment or whatever it might be, but hopefully as a group, we can do that. And I think we can do that within Anthemis because we have some level of scale, but we can also do that as investors, as we co-invest with others and being quite kind of thoughtful in terms of why we've decided to come into a deal with certain investors, why we've decided to reach out to other investors about co-investing with us in other deals as well.
Yeah, it's a very interesting point about the co-investors and kind of wider ecosystem. And Lisa, maybe also to the same question, how do you choose your priorities? And I know you have done a lot of deals in healthcare and edtech, govtech. So how do you choose where to focus next?
So in terms of strategic priorities, that's set across the foundation, and our investment strategy is aligning with our kind of research and program work. So the kind of priorities of focus are coming out of that, but also where we see investable opportunities. I think in terms of just going back to how we work with founders to agree and on the kind of definition of impact and the metrics that will follow. During the DD process, we will co-develop with our founders what we call a theory of change, which is a kind of logic model around this is what the company does, and these are the outcomes, the kind of social impact outcomes that we aspire to deliver, and what are the kind of activities and steps that get from what the company is doing today to those aspirational outcomes. Where do we have data to validate the hypothesis of that logic flow? And where do we need to gather data? So that we are, with the company, helping them to build their evidence base for the impact that they say they're delivering. And it goes back to a point that someone made earlier, which is materiality, proportionality. We don't want to overburden young early stage companies with bureaucracy and administration. We want to make sure as far as possible that what we're asking them to do is going to be for their commercial benefit and deliver impact as well. So for example, in some of our edtech businesses, they built the evidence base to prove that their technology or their solution is raising attainment for students. And that then helps them to go and sell to the next school. Or they're saving teachers time in terms of they're reducing teacher workload. That helps them to go and sell more to schools. So there's that kind of virtual circle of the impact being beneficial to those that are kind of involved in using the services, but then that also translates into commercial benefits for the business. I just also wanted to mention, as part of that process, that theory of change that we develop with the companies, that feeds in then to our impact assessment methodology, which I'm happy to share if it's of relevance. We look at impact return and impact risk and various factors within that. And we've got a scoring kind of mechanism so that we will score every investment at the point of investment, and then we will track that score through the life of the investment and across the portfolio, so that the methodology allows us to both define kind of bespoke KPIs that are relevant and beneficial to each individual company, but it also translates into a quantitative score that we can then look at a benchmark across the portfolio.
Yeah, thank you so much for sharing that. I'm just mindful of time, so I think that was a really great discussion. Thank you so much for your insights. Obviously, it's a very large topic to cover in one panel, but hopefully this was one of the first ones and among many ones to come. I would suggest now to start taking the audience questions, because I'm sure they're also impatient to get your view on some of things that keep them awake at night. Maybe one of the first question is, do you think ESG investors should be held to the same return requirements as non-ESG driven funds? Or shall there be any kind of framework to account for this ESG focus? Anyone, please feel free.
I mean, we have a very strong view on that. So we really view this as being the sort of a theme that's going to generate outsized returns. And so I think they should definitely be held in the sort of ESG and commercial impact side of it. The returns profile should be at least as good as sort of mainstream investing. I think, as Lisa's very helpful diagram showed, there's a different type of capital and different approach for solving different problems. But in the space that we're talking about, the return should definitely be sort of, market leading, targeted at market leading returns.
I also think the term ESG fund is not right. Every fund should be ESG. The 50 good funds that we talked about, they're all mainstream funds. We don't have any impact funds in. Actually, no, we do. That's a lie. We do, but the main audience is mainstream funds, because this should just be table stakes. It should be part and parcel of what every fund is doing. It's just good kind of business and investment practice. So I think that when you say you're an ESG fund, I think at venture that's not really a term.
Yeah, I think we have another question related to that as well. So the question is, I think we can all agree that impact ESG investments are vital, and that funds are finally waking up to the fact that they can also create outsized returns for investors. However, we're not finding impact-driven businesses early enough. How do you see this evolving in the UK, where there's a lot less funding for pre-seed companies when compared to the rest of Europe?
I would contend that a little bit. I think we not only have a really robust system of grants for super early at idea stage, or even I would say even before you have an idea, when you have a thought, you could probably go out there and raise a grant. I think angel investors, especially with the tax incentives as well in the UK, are pretty robust from a system there. And then I think there are more early stage pre-seed investors than ever who really kind of value this sector and are looking for deals in this sector. So yeah, can we do more? Totally. But I do think that if you have a really solid pre-seed, kind of venture, you should be able to find capital for it, because there is alignment with investors now more than ever, and there is capital in the market as well.
I would just add that there are accelerators like Bethnal Green Ventures that have positioned precisely for this kind of, they're looking for tech for good, very early stage ventures. So I can only see that that's end of the market is growing as well.
Yeah, thank you for that. So we have quite a few questions about the slides and metrics and framework. So I guess what would be helpful is, as a follow-up to this session, we will share everything that was mentioned in the panel, the research, the frameworks, so that the audience can also get acquainted with that, because that's one of our goals as well, to promote more awareness and kind of encourage the public to be more educated on the ESG matters. Maybe the next question is, how about attracting the best founders as they want responsible VCs on their cap table? I guess this is one of the reasons we could also add to the poll is how do you think it's important to be responsible VC to attract best companies and best founders? Maybe Camilla, you would.
Sorry, I wasn't sure that was a question. So I think it I guess I think how we see it is that like all stakeholders, whether it's a founder, whether it's employees, or whether it's capital, is all moving towards this world of wanting to have a positive impact. So a lot of the very forward-looking founders, very focused on building these businesses with sort of that are very mission focused and therefore want mission aligned capital. So I guess we're relatively early as a fund. We sort of made 3 investments. We're in the process of making a 4th. And I think 2 of those investments we specifically were able to win because of the sort of thesis that we had around impact. And those founders were very focused on as I sort of mentioned earlier, like who our LPs were and what we were doing to help them think about this sort of in the future. So it's very, very early evidence around that, but I think we're definitely starting to see the different access that we have to founders by having this very clear thesis versus when we were sort of investing in a more generalized thesis. I think as more funds move in this direction, then I think, that will start to sort of move away. But to Farhan's point, I think one of the I guess most early stage businesses have multiple investors in, and so I think funds that have a specialism focused on this are then very logical co-investment partners for funds that are sort of moving in that direction, and there's a sort of natural sort of partnership around that and sort of working together to help these businesses evolve in the right way, and founders seem really excited about that.
Great, thank you, Camilla. So the next question is, when analyzing an impact investment, do you also look for factors such as B Corp certified, incorporating social mission and asset lock into articles of association? Additionally, how do you see investments in social enterprises who are probably less investable since they commit to reinvesting 50% of their profit to support their cause evolving? If anyone would like to take this question.
I can go first, and I would say we don't necessarily look for specific certifications unless they're going to make sense for the organization, right? If it makes sense to kind of like get some of these certifications, especially because we're doing pre-seed, at least for me, I'm doing pre-seed and so early in their journey, right? It's really more about like, is there a problem, right? Can you get to product market fit? Can you get to even market entrepreneur fit, right? On that front, like, is this the right thing that's going to provide a solution, right? And then as the certifications become more and more relevant to those organizations, we'll look at those. But it's not something right off the bat that, at least personally, I kind of try to influence founders to get in order to get the investment, at least at the pre-seed level.
I think we're sort of quite similar. So we have a requirement in the document. So we include a social mission statement in the articles of association. We include the responsible business practices, and then we work through the IMP framework. So I think very similar to sort of Lisa, but in terms of signing up to things like B Corp, we really allow companies to make their own decisions on that. And I think there's all of the different frameworks out there. There's positives and negatives. And so we really want to empower founders to have impact through the business and then decide what's the appropriate sort of mechanism or forum to sign up. And I think as a result of that, we're seeing some of them start to like really innovate. So we have an investment in a company that is about to announce like a climate initiative that's like really, really exciting. And they've decided to prioritize investment in that versus the sort of time that it would take to sign up for B Corp. So we sort of trust founders to be more innovative than we are, or some of the standard bodies are, and sort of creating change.
Great, very interesting. And another question we have, I would say that impact investing is about additionality. It specifically addresses market failure. However, there are the likes of the Wellcome Trust who would say that for optimal, in their case, very successful outcomes, it is important to consider each opportunity in its own right. Would the panel agree? Lisa, maybe you would like to take that?
Yeah, I would agree with that. Yeah, I mean, we can identify systemically where we think there are market failures and craft an investment strategy around that, but the individual opportunities will sit within that broader picture. So yeah, I would agree that you can do both.
Great. Maybe another question. So we know, especially when it comes to environmental issues and concerns, one of the challenges is kind of greenwashing. And this is a question we have in the chat, saying greenwashing is a big concern in ESG medium. Could these issues transfer to the VC sector, and could this affect the VC portfolio, the greenwashing?
Definitely a big risk. I think there's, I think we'll probably all agree there's a lot of rhetoric in the space, and I think that's where we have to move towards some form of accountability. And if that's through a common set of metrics, then that will keep both funds and their internal fund management processes and then their companies accountable on a lot of these different areas. So I think that is one way to stop to prevent greenwashing from happening.
Anyone else would like to add anything?
Yeah, I think there's definitely a massive risk. I think one of the good things about including a tool in your process is that so much of it is about founder intent. And as you start to go through a sort of that process of really unpicking what the founder's motivation is and how they're thinking about some of the levers for building defensibility over time, you start to get a real sense of whether, especially in the consumer space, whether they're greenwashing or whether they're really trying to drive change. And I guess our sort of belief is long-term that also drives commercial value, because consumers are getting very sophisticated around brands that greenwash versus brands that are really trying to change the status quo. And that sort of helps drive that circularity again.
Thank you. Thank you for that. Another question we have is about the systematic approach on which you assess the expected impact through your investment process. So I think we already briefly talked about that and some frameworks, but if there's anything you would like to add on the topic.
I mean, no, as I said, I'm happy to share our approach, which I think Evgenia will circulate in the slides, where we set out our methodology around impact assessment. And I think there's a link also to the impact management project, which Camilla's referenced as well, which I think is a really, really helpful starting point for anyone who's thinking about this.
Yes, that would be really helpful. So we'll distribute the research and resources that we mentioned after this session. And another question is, how do you educate other stakeholders on ESG topics, be it internal stakeholders within your company or external, such as founders, LPs, anyone else?
Sorry, Evgenia, can you repeat that question?
Yeah, how do you educate other stakeholders on ESG topics, for example, internal within your company or external, the founders, LPs, anyone who is less familiar with the topic?
I mean, I think the education piece is a huge one, and that's probably where we need to start at the moment, because there's a lot of not confusion, but I think that people aren't clear on what ESG is and what it means. And I think you need to adjust the message when you're talking to different groups of people, so different stakeholders. So LPs recognize ESG as a term. I think when you're talking to founders, talking about ESG isn't particularly helpful, doesn't resonate, they don't really understand it. I think their skin probably prickles a bit and they're like, oh, they just kind of think box ticking. So I think you need change the language, and I think Farhan mentioned this, but like talk about the why, like the why is it important, the context, like why are we trying to work with them on these pieces, and what does that mean for them? And I think one of the things that's not really, we're not at that point yet, is the best practice. So it's really hard at the moment to point towards best practice, to say this is what good looks like. And I think hopefully collectively as a community, we can kind of actually come up with some of that research to say, like, this is what good looks like, and this is the trajectory in which you should move in direction. And you can talk to this company, this company, this company, and, you know, having that resource base as well of like offline policies, tools, platforms, like things to read. Like, I mean, I share really nerdy responsible venture capital reports with everyone after a call, which people are probably going to get fed up with sooner or later. But I think like being able to share, because we all read different things, we speak to different companies, and we have different insights. So I think that's one way to educate people.
Farhan, would you like to add anything on that?
Well, I was going to say, on the flip side of that is also being receptive, right? And being open, because I think we are still quite early in that kind of process, and things are going to evolve, right? And there might be things that, you know, in the same way that some of these kind of things have been accelerated. I think it was Lisa who mentioned kind of the Black Lives Matter movement last year and stuff, but there's likely to be other disruptions, right? And other things that accelerate some uncovering of other concepts that we didn't kind of recognize at this point in time, but we will recognize a year from now or 6 months from now or whatever it is in that period of time, right? Like based on recovery here through the pandemic, based on, you know, the economic situation, based on innovation as well, right? And how kind of innovation might advantage some groups and communities, but might disadvantage other groups and communities. So just kind of being conscious about that and being open to the feedback and listening to each other, I think we can go a long way. And I think events like this are really kind of great for hopefully kind of opening people's minds, and, you know, kind of how do we have more of these types of events? How do we have more of these types of discussions? And how do we broaden out that community that's listening and is kind of also informing the rest of us around, you know, areas we might have missed?
Yeah, I think that's a very important point. And I guess as someone pointed out before, it's important, there's a bias maybe of self-selection here, and it would be great to also involve people who are not inherently interested maybe in the topic. And so how do we kind of involve this broader community? Starting from the VC community, how can we maybe kind of accelerate the adoption of ESG principle and standards? As Hannah said, like every fund should be ESG, right? So how do we get there?
This is really one thing, and maybe I'm saying it slightly flippantly, but there's a strong case of FOMO happening, I think. So I think when funds start to realize that other funds are doing something, and oh, that fund there is doing something, then they start to listen. So I think there's kind of a little bit of a, whether you want to call it FOMO or domino effect, is definitely happening. And I think the other thing is like to look internally at your fund and make sure that everyone in the fund is aware of this stuff, and it doesn't just sit with that one person and they own it. It should be integrated across the whole fund. So that's another point.
Lisa, would you like to maybe add anything to that? What's your view on that?
I mean, you know, it's built into our DNA at Nesta, so it's difficult actually to step away from that. And you know, we all have responsibility on the kind of impact and ESG factors as much as we do on the financial returns. So, but that's a different model from your mainstream VC. So yeah, I just want to recognise that there are different models and different ways of ensuring awareness across different organisations.
Great, thank you for that. And another question we have is how can we assess the impact of new technologies, as we can't or yet understand or measure the long-term effect it can have on society or environment? Farhan, it seems like you want to say something.
Well, I mean, that's our job, right? Like it's kind of what we do day in, day out, is kind of lick our fingers and hold it to the wind and try to kind of figure out how the future is going to evolve, right? I mean, I think that's what we do for traditional innovation from a digital perspective, and now we're adding another lens to it, right? As investors, I mean, if we all had crystal balls, we'd all have outsized returns, right? And then you'd keep moving the needle forward, because not everybody can have an outsized return, because then the size moves. So, you know, kind of, I think we just, it's best guesses, it's guts, it's kind of like learning, reading, trying to kind of understand what trends are happening, trying to And I mean, at the end of the day, we're making bets on these investments, right, around kind of what the world's going to turn out to be. And I know a lot of our companies saw accelerated growth as a result of the pandemic, and that's not always a good thing, right? In terms of, it means that other people are being disadvantaged, other people are needing some of these tools for financial wellness, at least in our case as well. So I think it's really, you know, kind of doing more of what we've been doing, you know, over our careers as investors, is trying to kind of figure out which way the future is going to look, and trying to kind of also build that future, right, in the way we want to see it come out as well. You kind of have to build the world you want to see.
Yeah, and you're raising an important question there. So, for example, typically investment period of 10 years for VC funds, do you think it's maybe too short to see the actual long-term impact on the society or environment? And does it actually influence people to be a bit more short-sighted in terms of getting return on the investment and not thinking long-term enough?
I mean, I just say I'm a big fan of Mariana Mazzucato's kind of work on this space around kind of like, you know, kind of longer time horizons and stuff. I just think we don't necessarily have the systems in place yet to do that. But I would love to hear what Hannah, Camilla, and Lisa have to say on that point as well.
I think there are more models of patient capital emerging, still kind of at the edges, but you can use, there are more evergreen fund models emerging. So I think that there is a kind of slowly growing recognition that maybe a longer time horizon is necessary, particularly in light of climate change and the climate tech kind of time required to deliver. So you know, I think, you know, we can see some green shoots, but remains to be seen to what extent the whole system shifts in that direction.
I would also add that you know, 10 plus 2 or 12 years is a pretty long time. I mean, in conversations with LPs, they definitely think it's a long time. But I think it's in the sense of it's a long enough time to get a sense of whether a company is heading in the right direction and having a decent impact. So I think in that sense, if you get it in place early and you track it over a 10-12 year period, then the likelihood is that it's going to continue on that path, on that route.
Yeah, I sort of agree with that. I think, you know, early stage investing, a 12-year fund, 10 plus 2, you've made most of your investments in 3 years. And so the majority of those companies are relatively mature, and you're starting to see what level of impact they can have. And I think financing is only one aspect of those companies. There's now increasing opportunity to sell in secondary, which doesn't impact like the potential for that company to go on and sort of build its full potential, but allows VCs to recycle the capital and go back to sort of investing in the next wave of innovation. So whilst evergreen funds would be really fantastic, I don't think it at the moment is negatively impacting the trajectory of those companies.
Thank you for that. And I'm just mindful of time, so maybe the last question. So we know you mentioned the Lisa B Corp framework, and then we know some of the VC funds have become B Corp certified. Maybe the question to the whole panel, like, do you think it's worth for a VC firm to become B Corp, and does it make a difference when talking to any external parties?
I think it's, you know, it's a signaling mechanism of intent, but it comes back to this question of proportionality of, you know, to what extent does the firm have the resources to engage in what B Corp assessments require, and it's not for everyone. So I think, you know, it depends on why you're doing it, and whether you can follow through as well, because it's not a one-off certification. You have to keep on top of all aspects and get recertified every 2 years. So I think it's quite a big commitment, not for everyone, but for some it can be be valuable. And also maybe for those who want a framework for accountability to say someone is going to hold my feet to the fire every 2 years, it's a really good way of doing that.
I don't know whether this is relevant for funds or for companies, but it's also not, they didn't design it for venture. They didn't design it for early stage. So it is applicable to a whole range of sectors and types and shapes and sizes of companies. So there is an argument for maybe if you do have it, there are probably other things that you might need to supplement your process with so that you're capturing all relevant issue areas.
Yeah, and maybe Farhan, you mentioned that you're signatories of UN PRI, which also, as we know, is not designed specifically for ventures. So how do you kind of deal with this?
Well, I mean, it's a starting point, right? So you kind of look at it and you see all the things, and I, at least personally, feel like none of those are too big an ask, right, on that front. So if you can use that as the starting point to signal kind of that this is what you want to do and have, you know, kind of a community of people helping to kind of guide some of those changes, I think that's how we're kind of approaching it. The other thing is like also thinking about who we hire, when we hire, how we grow. I think Camilla made a great point earlier on about, you know, kind of when to hire an associate and how much to pay that person, or, you know, kind of what you could do versus what you should do, right? And I think that kind of helps as a guiding principle as well.
Great. Thank you so much. We're running out of time, but it's been a super interesting discussion with great insights from all of you and great questions from the audience. Thank you so much for being here. Really appreciate the input. It was great to have you here, and please stay tuned for our next editions of VC Lead Ladies, and hope we can continue this ESG discussion very soon with all of you.
So thank you for having us.
Thanks.
Thank you.
Thank you.